Imagine this. It's the year 2000 and you have a stock-only portfolio. We know that was the top in hindsight. What should you have done? No one knew for sure, but there were clues. In hindsight, valuations were stretched. Tech was overheated. Cash would become king. Here's what a smart investor could have done. Raise some cash is option number one. Hey, why not trim 10 to 30% of your riskiest stocks and have some cash? Number two, sell covered calls. Lock in some income in case those stocks decline. Reduce the exposure if they get called away at a profit. Because remember, when you sell calls, you get paid to sell at a higher price. Number three, set up option collars. The way you do this is you sell a call and you use that income, that premium you collect, to buy some protection on the downside. You collect some premium, you use that money to buy some premium protection. Sell out of the money calls to pay for those protective puts. It's a way to lock in gains and cap the losses. Number four, rebalance the portfolio. Move 20 to 30% of that stock-only portfolio that may be in only growth stocks. Switch some of that into value stocks, maybe bonds and or treasuries, some REITs, some international stocks. You spread it around so it's not just in what's most likely inflated growth stocks. Number five, buy some gold. What tends to happen after a recession or after a slowdown is the government steps in and starts trying to save the economy, and that may be with debt or inflation. So 5 to 10% gold position as a hedge, and it's a great time to use overvalued stock to buy probably cheap gold. And in hindsight, gold did outperform the NASDAQ after the 2000 crash. Number six, reduce margin debt. If you have any margin debt, if you have any credit card debt, any debt that you may want to get rid of, now is a good time to pay it down with this inflated stock. Clean it up before the storm hits. Number seven, take strategic gains and losses. Lock in profits on those huge winners, not all of it, but at least some profit. Harvest losses on those laggards, and that way you reduce any taxable gain, potentially. Let's summarize. In any overheated market, raise cash, hedge smart, rebalance, build optionality. You'll be ready to pounce when the markets drop. Did you survive the 2000 crash? What about 2008? Would you use this strategy or any part of it next time? Drop your thoughts in the comments.